Good afternoon, guys. Good afternoon. I'm just going to give attendees another couple of seconds just to enter the room. Excellent. All right, so thank you very much for attending and thank you very much for your time. As you can see from the screen, we are looking at combining macro and technical analysis to trade, which in my opinion is the more it provides a clear edge to trade, I believe, and it adds something to technical analysis. So for any technical analysts watching, this could add another edge to your trading. So my name is Aaron Hill, and I am the Chief Market Analyst here at FP Markets. I assume that the sound and visuals are coming across loud and clear. If there are any issues, do let me know in the chat, and I'll try and get one of the team to have a look. So before moving on with this with the webinar, of course, there's a disclaimer. I won't read through the entire thing, but suffice it to say that the following presentation should not be considered investment advice. It should be treated as educational material only. Now, the summary or the agenda of this presentation is set around, of course, combining macro and technical analysis, how macro sets the stage for technical trading opportunities. This is something technical traders often miss. So they focus on their technical levels, but they often miss that macro edge, which you can get, especially if you're trading FX like I do. Filtering noise using macro to validate or invalidate a technical signal, and identifying those high probability trading opportunities that we all strive for. Those trades that provide that clear edge to put money at risk. And of course, like every webinar, your questions will be answered. I do tend to open the floor at the end of a presentation, as it offers more of a clearer structure to the webinar. But if you have a question relating to a slide or relating to a chart that I'm showing, please do fire across any questions, and I'll try to address that as we progress. So understanding, so just really quickly, I just want to say I am going to combine all of these bullet points into one large presentation midway through, where I bring in live examples of trades that could have been taken based on this trading strategy. So yeah, just bear that in mind as we progress. So understanding the interplay, how macro sets the stage for technical trading opportunities. So for me personally, I am an FX trader, and I always begin with the macro structure in mind. So this is how I will approach this presentation. It is, of course, it's not the only way of trading. I know technical traders that are steadfast technical analysts like I used to be. But this is the way I am comfortable trading. Hence, this is why I am confident to share this here. Without the macro backdrop, I now feel blind trading technical charts. It really provides so how I explain this is that the macro answers the question of why you take a certain trade. Technicals answer the question of when to take a trade. And the technicals do a great job of offering you a precise entry point and a risk point. So it helps define risk management. So they both complement each other in certain ways. You do not need to be an economist, or you certainly do not need to be a financial, study a finance degree or anything like that to trade this, to trade in this fashion, which is fantastic because you can learn for free online with webinars just like this and with further education. But really, it is relatively straightforward as long as you're willing to put in the work, like everything, I guess, like everything that's worth doing. So I see the macro stage in terms of three pillars, as you can see here: central bank policy, economic data, and geopolitics. As long as these three are in line with one another, this is when you get those real strong high probability trading opportunities. Now, I have been over each component in detail in previous posts, but for those new to the webinars, I'll break down central bank policy and I'll break down economic data. The reason for leaving geopolitics on the sidelines for now is I will touch on this when we get to those live examples. And I have got an entire webinar based on geopolitics for traders. If you want to have a look at that, please feel free. So for me, everything begins with the central bank policy. The next question is I often get is what central bank do I follow? Do you focus on, as you can see to the left there, do you focus on the G10 currencies, the dollar, the euro, the pound, or do you focus on the most widely traded currencies? As you can see here, that's the US dollar, the euro, the Japanese yen, and the British pound. How do I know they're the most widely traded currencies? Well, we look at the Bank for International Settlements. They provide a triennial survey of FX turnover, and they provide you with all of these key data relating to the FX space. So the most widely traded currencies, the most widely traded instruments, so swaps and things like that. So it's certainly worth checking that out. The latest one is, of course, for 2022. There will be one out shortly, I believe, for 2025. But the point is, sorry, the point is, what central bank do you follow? So I would, if you're just beginning to focus on the macro stage, I would wholeheartedly recommend just focusing on two currencies. So let's stick with, say, the euro and the US dollar. If you stick with them, learn about the central banks, follow their statements, follow their key central bank speakers. You need to put in the work to understand what the central bank's bias is. So you build an understanding of where they're headed. I cannot emphasize how important this this process is. Is the bank hawkish? Is the bank dovish? What is their story? Are they looking at inflation? Are they looking at growth? Are they looking at employment? What is the evolution of their thinking? Make notes and keep track of this. I would recommend doing that. And you'll be surprised at how quick you start to see the story. As I said, if you're beginning, just stick to two currencies. Focus on the US dollar and the euro. It might seem boring at first, but once you get a handle of those, you can then branch out to other central banks like the Bank of England or the Bank of Japan, for example, and combine this. So by focusing on the euro and the ECB and the Fed, you can then trade the euro dollar. You'll be surprised at how many traders do just specialize in a couple of currencies, and they do very, very well because they understand how those central banks work. They understand the differences between the two central banks, and they understand where their edge lies. Now, there are a couple of things you need to be aware of with central banks. So what tools they use, what tools do central banks use to influence monetary policy? As you can see here, we have the target interest rate. Now, depending on the central bank you're focusing on, the interest rate is often just look at Forex Factory. If you just type in Forex Factory and just look at the calendar regarding how they refer to their target rates. I mean, the Fed uses the Fed funds target rate. You got the RBA and the RBNZ. They look at they refer to their overnight rates as cash rates. For the ECB, they have three benchmark rates: the refinancing rate, the depot rate, and then we have the Bank of Canada, right? It's the overnight policy rate. So just be aware that they are termed differently, but they really all mean the same thing. They're the overnight rates, are the short-term interest rates that the central banks use. And they can have, when the central banks alter these interest rates, they can have a marked impact on asset classes, including currencies and associated bond yields. Now, the central bank tends to increase rates to temper inflationary. We saw that back in 2022, right? So when inflation was spiraling out of control, what did central banks do? They raised their overnight rates. You can see it. Look back at the charts, and you'll see the overnight rates just increased following that inflation. And central banks often lower interest rates to help tame higher unemployment or to boost economic growth. Now, once the central bank adjusts their policy, what happens? So when the central bank adjusts their overnight rate, they influence the interest rates set by commercial banks for loans and savings, which in turn affects the overall consumer and business spending. This is the ultimate goal. And this influences inflation, spending, and economic activity. So a higher rate tends to reduce borrowing, increase savings, and slow spending to control inflationary pressures, right? While a lower rate does the opposite. It encourages borrowing, it discourages savings, and increases spending to stimulate the economic activity. So another tool that the central bank uses is the balance sheet. You'll often hear this if you watch any financial news outlets. You'll often hear the reporters talk about the central bank's balance sheet, especially heading into key events. So the size of a central bank's balance sheet can also signal certain actions and impact the markets. So central banks expand their balance sheet by purchasing assets. Most commonly, these revolve around the government bonds or sometimes other securities, and this is also known as quantitative easing or QE. Central banks reduce their balance sheet through a process known as quantitative tightening, and this is essentially the reverse of QE. So they sell their bonds. This is certainly something to be aware of, and I would encourage you to look into this more. This is just to highlight the key tools that central banks have. Now, another one that the central banks do, one of the tools that the central banks use is signaling, which is very, very, very important. And we saw this with Fed Chair Powell last Friday. I will be touching on that very shortly, and I will use that as an example to show you where we could have entered short on the back of that on the dollar. So central bank signaling is, well, as its name implies, it refers to the communication from a central bank to influence market expectations and economic behavior. So they're essentially, without necessarily taking any immediate policy action. So central banks communicate their intentions, their concerns, and likely, I emphasize the word likely here, likely future actions through various channels. These can be speeches by officials. Again, I will touch on that shortly. This can be the policy statements, the accompanying rate statements that accompany the rate decision, the meeting minutes. So, for instance, for anyone that's been in the markets for a short period of time, would have heard of the Fed meeting minutes, the RBA's meeting minutes, and of course, press conferences usually held by the heads of central banks. Markets as well as us, we should be analyzing these communication tools for clues about future interest rate changes, which can open the door to trading opportunities. The types of signals can be found through forward guidance, and these can offer dovish signals, which suggests accommodation or rate cuts. We can have hawkish signals, potential rate increases, or tighter policy, as some may refer to this as. So these are the three key tools. So we have the interest rates, we have the central bank's balance sheets, and we have signaling. Whoops, sorry guys. So I'm now going to switch over to the economic calendar because I'm going to get off of the slides and I believe more of a we can take more of a practical approach to this. So just bear with me. I'm going to now share my screen on the economic calendar. Here we go. Now, a common approach and one I favor, sorry guys, this is the economic calendar for Refinitiv or LSEG. It's a paid for calendar, and as you can see, it offers a slightly, it offers more information than the typical Forex Factory or the typical free calendars. Now, a common approach that I favor consists of, so there's two types of, if you're considering trading the news, there are two types of trading. There's trading out of the risk event or trading out of the economic data and trading into the event. Now, if you've ever heard of buy the rumor, sell the fact, well, that is trading into a risk event. You're buying the rumor and then you're selling that fact. This is why it can often lead, once the event or the outcome is shown through the data release, this can often confuse traders because traders have been buying the rumor and then they'll sell the fact. And this can often be contrary to the result or the outcome of that event. So I'm a big fan of trading out of risk events. I prefer that. I prefer heading into the event flat. I rarely, prefer to have a risk on the table heading into an economic data point, be it the Fed, be it the RBA, be it inflation, be it growth, or anything like that. I do not, I really don't like having anything on the table heading into a risk event because, and the main reason for this is because economic data can trigger some really strong moves, and this increases the spread dramatically and can open you up to gap risk. Now, for anyone that's been trading for any amount of time, try and get out of the market if there's a gap and it gaps in the wrong direction. You'll soon find out what happens. I can remember many years ago, I was trading the NFP report. This was years ago. It must be 7 or 8 years ago now. And I was trading the NFP report, and I was trading into the event. I assumed I knew better than the market, and I had some quite heavy risk on actually heading into the event, and it come out opposite to what I was anticipating, and it gapped the opposite direction. So I lost a considerable amount of money at that point and really changed my outlook in terms of trading into risk events. Look, some people can do it. And look, one of the things I would say is if you are considering trading into risk events and something, and when I do now trade into risk events, what I do is I take my risk off the table ahead of the event. So if we're trading in, say, trading into the NFP event, I will take, I will liquidate my position, square the position ahead of that risk event, so a day ahead. So slippage is in my favor, and I should have profited from the trend heading into that event. Now, as I said, I'm a big fan of trading out of risk events. And this is where an understanding of the economic data, as you can see on the screen, is key. And alongside that, you need to have an understanding of the narrative currently in the markets and the central bank's buyers. And what you can use the economic data for is to essentially, if you look back at the bullet points of this presentation, is to essentially validate or invalidate a technical approach, which is why I'm so drawn to this method of trading. Now, if only it was easy, if it was easy as trading beats and misses. So if only it was easy, to simply buy a beat on data or sell a miss. There is much more to it than that. So first and foremost, you need to understand that there's always a theme in the markets. There's always a theme across the market, and there's normally one dominant theme. This is sometimes referred to as the narrative. This is in my opinion, this is currently Trump and his tariffs and his recent attacks on the Fed. If you've read any articles today, you would be aware that Trump has not threatened, he has chosen to fire one of the Fed governors. I haven't looked at the news in the last couple of hours, so I'm not sure if she actually, Fed Governor Lisa Cook, actually showed up to work this morning, or if she was arrested. I'm not sure at work. That's something I will look into later. But nevertheless, the current narrative is Trump, tariffs, Trump, and the Fed for me. So from there, we need to know what the central bank is doing. We need to know their bias. So for instance, the Fed right now is somewhat dovish, uncertain. And then we can look at the data, and those data offer you the triggers. They offer you the triggers to get in and out of or in a position. You use technical analysis to get out of your position. I do. This is how I approach the markets. So keeping with the same example I mentioned, if you're just focusing on the euro dollar right now, we must understand what the ECB is doing and what the Fed is doing. For example, right now, I know that the ECB has lowered rates. I mean, they've lowered rates to a point where they're looking at potentially ending their easing cycle. What's the Fed doing? The Fed is still keeping rates at elevated levels. This is one of the reasons Trump continues to fire direct insults towards Powell, Jay Powell. I'm sure you've read about this. The Fed is still at elevated levels while the ECB is. So the Fed is looking at a dovish narrative while the ECB is looking at more of a hawkish narrative. So this may be euro dollar positive. Keep this in mind. So to understand data, I'm assuming that we have some newer traders here. This is the, as I said, the LSEG economic calendar provided by Refinitiv. And as I said, this is a paid for calendar, and it offers you slightly better response time for the data, and it offers you more estimates. So as you can see, this is Friday, 29th of August, and we have the core PCE data. This is a key data point, guys. For anyone that's paying attention, will be aware that this is a key data point. This is the marquee event for the week. The reason for this, aside from it being a tier 1 risk event, the spotlight was really thrown on this, given what Powell had noted in his speech last week. So from the calendar, and the calendars are pretty much set up the same way across Forex Factory, Trading Economics, and things like that. So we have the local date, sorry, the date. This is the date according to my time zone, local time, the currencies or the countries that it will affect, so the currencies as well. So the US and Canadian dollar and things like that. And then it has the impact rating. Again, it will be very similar on Forex Factory and things like that. But as you can see here, the PCE price index has a high market impact. Pretty obvious. Then we have the period, what the data is referring to. Forex Factory doesn't actually show this, but Trading Economics does. It tells you what the data, what month the data is being reported for, and whether it's a year-over-year data point. So is it comparing July with July the year prior, or is it comparing June and July, so a month over month? Then we have the Reuters poll, which is brilliant in my opinion. It's really, really effective. This is the median estimate. So we have a distribution curve, and that is the center of the estimate. So we have 2.9% for the core PCE. And this is the prior data here, 2.8%. This is what was, this is in June's data for the year-over-year print, 2.8%. These are very, very helpful for trading risk events. So this is the maximum and minimum estimate. So the current high, as you can see, is 3%, and the current low is between 2%. So we know roughly it's a pretty tight estimate range. If we get anywhere out of those estimates, we know there's something wrong with the estimates, and we could see some strong moves in the markets. Pretty much the same across the board here, guys. We have Canadian GDP quarter over quarter. Then we have the prior data. Some data points do not offer estimates, some do. And those are the ones you want to trade, is where there is clear-cut estimates. Most of the tier one risk events do offer clear estimates. Are there any questions regarding the calendar? It's pretty much as simple as that, guys. You can alter the calendar to suit your personal preferences and things like that. Other than that, I don't see any questions. So let's continue moving on. So how can we use this as traders? I think it would be best to try and explain this using an example. So let's scoot back to what Powell said. So I was heading into Powell's speech on Friday. At the beginning of the week, things turned dovish. Things were dovish. Everyone was expecting Powell to come out dovish, but then what happened is everything midweek turned hawkish. You had Fed officials coming out saying we need more definitive data before making a concrete decision. We do have some Fed members, we have the likes of Christopher Waller, Michelle Bowman, who are looking to cut rates, who are advocating cutting rates, but there was a number of other Fed members coming out and saying we need more definitive data before making a decision. This, for me, is hawkish, and this is what the markets were looking at. They were looking at some, they were offering very, very little ahead of Fed Powell speech, which was taken as hawkish. Couple this with the S&P 500, the US S&P 500, sorry, the US S&P global PMIs coming out better than expected, especially on the manufacturing front. That jumped back into expansionary territory. Another hawkish signal. So it was heading into Powell hawkish. Then all of a sudden Powell come out and said what? Two sentences caused all of this movement on the US dollar index. So on the US dollar, on US yields, stocks. So Powell's commentary, I have them noted here. Downside risks to employment are rising, and the other point, the other comment was shifting balance of risks may, here we go, warrant adjusting policy. So he's indirectly said that the balance of risk shifting from inflation to employment warrant adjusting policy. And here is the move. So that the speech was I think it was around 15 minutes, and that was the same as last year. I think it was 20 minutes. But if you look on the US dollar index, now this is where Powell started speaking. Look at that move. This is the 5-minute chart, so you have plenty of time to look at things. And this is, imagine this was a data point, so a data miss. You have plenty of time if you trade out of risk events. Now, given the dovish comments, how would you have entered this trade? There are two ways that I know of. You can enter straight away, but you are opening yourself up to considerable slippage risk. So it could be, sometimes it can be up to 40 pips or something like that, something insane. You can catch the move, but you'll be in at a terrible price. I prefer to wait. So not only does that give me more time to assess the landscape, it also gives me a better entry, well, I feel a better entry in terms of risk to reward. So this is where Powell started really giving those dovish comments out. And look at the move to the downside. This was 0.5% in 5 minutes. So we continue going lower. And this is what I look for. I look for very simple. For anyone that followed my technical analysis webinars, you'll know I'm a big fan of key support and resistance levels formed by Quasimodo resistance levels, but I look for those IQMs, those ignored Quasimodo levels, and I look for quarterly levels, so the quarterly open levels, the half yearly open levels, and those yearly opening levels. Here we had a perfect opportunity. I mean, look at this. Absolutely a perfect opportunity. So we had a left shoulder here, a high here, a low here, and a rally to the upside. This is an IQM. And look, it was completely ignored to the downside here. We smashed straight through that. and then we retested the underside here. I mean, look at the risk to reward for this trade. You have plenty of time. This is 5 minutes into 5, 10, 15, 20, 25, 30, 35 minutes into Powell speech. You have plenty of time to assess the situation here. And look at the entry here. The entry would have been here. You could have, this is where you need some technical knowledge. Where would you have placed your stop? Right, so for instance, you can see there's a decision point here. Not a great one, but there's a decision point there. But there's also a smaller decision point here. And this for me was the most important decision point. I'll move this other box out of the way so you can see it. This for me was the most important because this is where a decision took place to break through that IQM, through that QM. At the point, it was a QM. But once we broke to the downside, this was a key decision point. And look where price tested. Price moderately whipsawed through that IQM, tested that decision point, and then dropped to the downside. Now, if you're an aggressive trader and you have the sentiment in your favor, you could have simply entered short at this point here, placed your stop just above this area, and look at the risk to reward you could have nailed for that trade. I mean, you could have been in the trade for 30 minutes and got out at a good 3 or 4 risk to reward. And this is the power of following macro and combining that with technical knowledge. So this was a clear-cut trade where Powell had shocked the markets. Are there any questions about this type of trade, especially from Powell? So following Powell's comments, we had the dollar to the downside. We have yields to the downside. I mean, if you have a look at stock markets, stocks rallied to the upside. So you can see this was on, oops, that should be clearer. So we had stocks to the upside there. You can see the S&P on the lower left chart. Stocks rallied at 1.5%, but have since petered off. So this is the type of trades you look for. You have to keep your finger on the pulse and look for those high conviction trades that present themselves when you follow the bias of the central bank and the economic data. What's next then? So what do we look for? So with Powell in the rearview mirror, what's next? We have the PCE data, as I've just been discussing there. So we have the PCE data coming up. Now, what do you think is going to happen with the PCE data? So assuming Powell's turned dovish, we can see Powell has noted downside risks to employment are clear. What about if PCE data comes in better than expected? Say, I do hope the screen's showing there. Yes, it is. So assume let's just assume we have core year-over-year PCE coming in at 3.1%. This is above the upper estimate range. Assume we have the headline year-over-year coming in at, say, 2.8%. Just a quick point on the PCE data, guys. You'll often find that trade, I'm not sure why, but market pundits, or Fed watchers as well, they say that the Fed targets the core PCE inflation index. They don't. They actually target the headline all items PCE price index. If you look back to 2012, when they started targeting inflation, this is the index that they noted that they watch, and it's clear they target the headline PCE data, not the core data. Just bear that in mind when you if you are trading the PCE data. So back to where we are. We know Powell has shifted dovish. And this really throws light on PCE data. It throws light on the CPI data, the PPI data, and the upcoming labour report. So we have the labour report coming out next week. Then we have the CPI data. Then we have the PPI data. Then we have the CPI data. So again, what do you think will happen to the likes of the dollar and US yields and stocks if we see core PCE and PCE come in higher than expected, given what we already know from Powell? Well, this should really pour some cold water on Fed rate cut expectations. Right now, let me see if it clicks over. There we go. Right now, we are at 21 basis points of easing. This is for the 17th of September meeting. So markets are all but fully priced in, 84% probability for that event. Now, what do you think is going to happen to the rate pricing if PCE data comes in better than expected? Well, we are going to see traders reprice out some of that easing. And what do you think going to do to the US Treasury yields? It's going to bolster those. You're going to see a rise in US Treasury yields. You're going to see a rise in the dollar. You're going to see a deterioration in the stock market, a pullback in the stock market. And I genuinely think this is why, if you look at the dollar index right now on the daily chart, we are in a consolidation. I don't envisage we are going to break out of that before this PCE data. Markets are in a wait and see mode right now until that PCE data comes out, until that labor report. Man, that labor report is going to be a widely watched event, and could open the door to some serious opportunities. Now, assuming PCE data comes in hotter than expected, dollar rallies, US Treasury yields rally, stocks turn lower. Now, what about if the labor market shows a rebound? I mean, if you remember the July labor report, what happened? We had a significant deterioration of the labor market. We saw, on average, over a 3-month average, 35,000 new payrolls were added to the economy. This was a considerable shock, and this opened the door. Let me try and find where this was. I can't remember the date when this was shown, but this, I think it was here. There we go, the 1st of August. Let me just check my calendar. Yes, so it was here, the 1st of August. This move here, down 1.37% on the day. This again opened the door to a considerable trading opportunity where you can trade out of that risk event. As soon as that NFP data landed, you could look for bearish shorting opportunities. I touched on this, I believe, in my last webinar, so it's certainly something to check out. Okay, so assuming PCE data comes in better than expected, assuming we get a better than expected rebound in the labor data, what do you think is going to happen to Fed rate pricing? Further, there'll be less cuts priced in. September may even be off the table. What about if CPI data comes in much hotter than expected? What about if PPI data comes in hotter than expected? You may recall from the last PPI data, it considerably beat expectations. PPI data, that's the wholesale price inflation, but CPI was largely tame. From memory, I think core inflation came in at 3.1%. So this is still high, very high. I mean, the Fed targets 2%, right? And we know they target the headline PCE price index, but they look at a wide range of measures. So knowing this can open the door. So knowing the central bank's bias, knowing how they're positioned, and knowing what data is key, this can really open the door to sizable trading opportunities. So if PCE data comes in hotter than expected, we can look for a potential long opportunity in the dollar. If it comes in much lower than expected, we look for shorts in the dollar. Now, if the labor market comes in much lower than expected, we could see a break of this support and a break of these lows, and potentially notch out fresh year-to-date lows on the US dollar index, targeting this support at 95.67, which, if you're fond of the technicals, could lead us below this monthly channel support line. So this is how I look at the markets. I look at it from the central bank to the economic data. So first of all, you need to understand the narrative. So we know Trump is the key narrative right now. And his Trump tariffs are potentially inflationary. But then we look at the central bank's bias. Now, monetary policy is one of the biggest drivers of FX market moves. So we need to understand the central bank's bias. We need to understand what economic data is linked to that central bank currently. Things change, markets change. As every man and his dog knows, Trump has been calling for lower rates. I mean, if you look at Friday, Trump's Truth Social platform, even though Powell suggested a dovish turn, Powell come out and called him too late. I won't go into what else he called him, but just look at these Truth Social and you'll see. So, as Powell recently put it in that speech, the Fed is in a challenging situation. If they lower rates, look, if they keep rates where they are, this, look, if they, let me just, I'm trying to think of the best way I can explain this. If they lower rates, if the Fed lowers rates, they risk fueling inflation, which, as we know, is far above the, not far above, it's considerably, it's above the Fed's 2% target, and that's a problem. Um, But if they keep rates where they are, they could reduce inflation, but this could influence growth and employment. And as we all know now, employment is a serious concern for the Fed right now. So where do we go from here? We know the Fed's position is dovish to uncertain. We know the upcoming data can be very interesting. Keep an eye on that PCE data, the US PCE data. If we come in positive, US dollar yields could rally. If we come in and stocks could turn lower. If we come in negative, the opposite effect could happen. So we need to follow the story of from the narrative, central banks to the economic data, and work from that way. Now, what I found interesting to do was look at these economic data, understand how they work, understand how they report, when they report, dive into it. Just take it one at a time. So you could start off with the big three: inflation, employment, and growth. Understand. So, for instance, in the US, GDP data is released in three estimates: the advanced, preliminary, and the final estimate. Understand how they do that. Non-farm payrolls. We've got private payrolls within there. We've got the unemployment rate. We've got wages within that report. Keep an eye on all of this data as it can open the door to good trading opportunities. All right. So, guys, are there any questions regarding the presentation? I think the questions will come up in the chat box. I do have someone raising their hand. Please just go ahead and ask the question and I'll see it in the chat box. Just trying to remove this. Bear with me. All right. Oh, there we go. Okay. Can this be watched again? Yes, there will be, for every webinar that FP produces, there will be a recording of this presentation. And look, guys, if you have any comments or any feedback, or you want any more information regarding what we've discussed here today, you can always email me and the team at marketanalyst@fpmarkets.com. We do check that email regularly, and we will reply as soon as we possibly can to any emails. So yes, to answer your question, there will be a recording of this presentation. I know it's a lot to take. I know it's a lot to take on board, but really don't overcomplicate this. It's three pillars, guys. You have the central bank policy. You have to understand the narrative, which is pretty simple. There's always one dominant narrative. There's rarely two. There's always one dominant narrative. Then we work from the central banks. Then we work to the economic data. And then we plan our trades with the economic data and the technical analysis that we look. Basic technical analysis is pretty easy to learn. But if you want more advanced, we do have a number of webinars, previous webinars that must be about 3 years old now, but they're still valid today. The IQM, the Quasimodo resistance, I think I did a 3-part series about 3 years ago, still valid today. Decision points, which I touched on in this presentation, we did a webinar on decision points. It's all there in the archives, guys, and this can be searched out through YouTube or the on the resources tab through FP Markets. Are there any other questions, guys? I don't think there is. That's great. All right, so look, thank you very much for joining. I do hope that this was beneficial. Oh, sorry. Just bear with me, I'm reading the question. Can one use information on websites like Bloomberg to set up trades? So Bloomberg is brilliant. I'm always listening to the Bloomberg's live TV. And I think you do have to subscribe for that, but I think the subscription is relatively cheap. So I'm always listening to Bloomberg, and it's excellent because it really instills a narrative of the market into you every day. So I'm listening to that all the time. Bloomberg is definitely one to watch, but there's also central bank report. Commercial bank reports. So, for instance, you can look at MUFG Bank, Bank of America. Just go on their website, search, sign up to their research reports. They're excellent. They really are. They really provide you with. So something I have been doing with AI is getting all of these central bank reports and combining them into one summary for myself to analyze the market. And it's absolutely brilliant because it combines like some of these central bank, commercial bank research reports are like 30 pages long. It's just too long to read in the morning. So you can use AI. This is where AI really steps into the fray for me. So to answer your question, I do use Bloomberg a lot. The live TV is brilliant. Um, I also use Financial Times. This is obviously I haven't got a live TV like Bloomberg has, and I also use Refinitiv as well as the Wall Street Journal. They're really good. Um, they're the most reliable sources I've found for my trading. Um, all right. So if there's no other questions, I hope that answered your question there. Um, have a wonderful day. And again, thank you very much for your time. As I said, comments and feedback to marketanalyst@fpmarkets.com. Have a wonderful day, and I'll catch you very, very soon. Thank you.